you can see that I drew a blue line, okay? The reason why it's there is because this is the GBP JPY weekly chart, okay? This is the weekly chart. And here you can see that September 2nd, 2018, they came to that area and went down from there, okay? And here, they came here, February 14, 2021, they touched that zone, went up, and here again in 2021, once again, they touched that zone, bounced right up. They also came to this level October 25th, 2009 and June 30th, 2013. This is a very good indicator because if they previously came to this level and give away good trades, chances are that if they come back again, they might do the same thing. So if you really want to increase your win rate, this should be one of the most important things for you to understand. Now that I've marked this level, the only thing I want is for them to come back to this level and start manipulating the market from there. I've found that they tend to come to these levels and create what I call patterns. Here's what I mean when I'm talking about patterns. When I'm talking about patterns, I'm talking about patterns like these ones, okay? These are the most common Forex patterns. One of them is the head and shoulder pattern. Here you can see a head, shoulder, shoulder. Then here, this is the inverted head and shoulder pattern. You can see the head, shoulder, shoulder. And a very common one is the double top, is the price will come from the bottom all the way high here, down, up, down. And the double bottom is they come from here all the way down, up, down. So when you map your crucial key levels, you're going to wait for the market to come to these levels and start creating one of these patterns there. So I mapped my level on the GBP JPY weekly chart, and I waited for the market to come to my crucial key level, and they came back September 21st, 2021 to this level, and I received a notification because I set up a notification system, and I waited to see if a pattern occurred, which they did. They came to this level September 21st, 2021. I received a notification on my phone to tell me, hey, the market came to your level. Go look if there's a pattern, okay? But there was none. But I looked in the lower time frames and I found one. Let me show you exactly what it was. This is the September 21st, 2021. So I'm going to zoom in the lower time frame. This is my level right there. And there you go, okay? Huge pattern, okay? They came to my level and created this huge pattern. And from there, they went up 300 pips. So you would have mapped your level, set up a notification system to get notified whenever they reach your level. And only then you look to see if a pattern occurred, which they did here. They create this huge pattern, and this pattern is called a divergence. Let me explain to you what is a divergence. Here's what Google says about a divergence, okay? A divergence is when the price of an asset is moving in the opposite direction of a technical indicator, such as an oscillator, or is moving contrary to other data, okay? A oscillator, this is what an oscillator is. This is also known as the MACD, okay? What they're saying is this. The price here is coming down, creating this on the oscillator, on the MACD, and they went up, further down. This is lower than this one, but on the MACD, this is higher than this one, when it should have been lower. So if you see something like this, this is what a divergence look like. Now, if we go back to the trade, this is the GBP JPY on H1, okay? This is the key level. They came to the area and then they created this pattern, which was a divergence. Price was coming down, creating this on the MACD. Then they went higher, then dropped lower. And on the MACD, it's higher. And then from there, they reverse, okay? Here, you can see that the price is going downward. And on the MACD, is going upward. So you would have taken a trade like this for 50 pips. You would have jumped in the trade. Here's your 50 pip right there. For 100 pips, here's your 100 pips. This trade went for 300 pips. So even at 50 pip, you could have ordered this several times and take 600 pips, 500 pips, 1,000 pips on that move or more. Okay? So, but if we move to a higher time frame, right there, this is the same trade, we can see that this level has been respected many times. Like here, they came to that area previously and they create a pattern. Head, shoulder, and shoulder. This is a head and shoulder pattern, and they reverse from there. They came back to the level. Another pattern, reverse from there. And then, once again, they did the same thing. They came to their level. This is a head, shoulder, and shoulder. Reverse from there. Now you should see that these levels are crucial. If you don't know this and you don't do this, this is why you're failing. This is why you don't get the 97% win rate, the 98%, the 80% win rates, because you're missing out on these levels, okay? Now you can, this is self-evidence that these levels are crucial. Now, let's take another look at other things. Before I jump in a trade like this, there's other major key things that I must have before I take a trade like this. Let me show you. One of the major key things that I must have before I jump in a trade is a reversal candle, okay? Here, you can see examples of what I'm talking about. Here, if you're looking for buys, you're looking for candles like these. Hammers, dragonflies, doji. And if you're looking for sells, you're looking for shooting stars and dojis, like this. And in this case, this is the same trade, GBP, JPY on H1, the divergence. And here you can see, clearly see this here. It's like this right there. See this? Same thing, okay? They came to my level, created a huge pattern, reversal candle, like this, reverse. Another tool that I like to use is the stochastic here, okay? The stochastic needs to be under 20 if it's a buy, or above 80 if it's a sell. And it needs to be under 20 on the exact time frame that you're about to take the trade. In this example, this is the GBP JPY on H1. The stochastic needs to be under 20 on H1. But here's another thing. The stochastic needs to be under 20 on H1, but also on H4 if it's a H1 trade, and daily if it's a H1 trade, M30, M15, and M5. And all of them, the stochastic needs to be under 20 when you're about to take the trade at the same time. Just like here, this red line represents the stochastic, which is under 20 now on H1. But if I change it to on H4, you can see that the stochastic, it's under 20 as well. And on daily, same thing, okay? Stochastic is under 20. If I go to M30, same thing, okay? And M15, exact same thing. So the stochastic needs to be under 20 on daily, H4, H1, M30, M15, and M5 when you're about to take the trade. If it's a H1 trade, the stochastic needs to be under 20 on daily, H4, H1, M30, M15, and M5. If it's a H4 trade, same thing. But if it's a daily trade, okay, the stochastic needs to be under 20 on these ones, the monthly, weekly, and daily, and so on and so forth. The higher you go, the stochastic needs to be under 20 on all of them, okay? at the same time. If you get this right, you have what we call a perfect entry, a perfect setup. This is for buys under 20, and if it's to sell, it's above 80. If the trade is on H4 and it's a sell, the stochastic needs to be above 80. Daily, H4, H1, M30, M15, and M5. And if it's a sell that you see a pattern on daily or weekly and monthly, the stochastic needs to be above 80 on daily, weekly, monthly, H1, M30, M15, and M5 at the same time when you're about to take the trade. Okay? If you do this, you get perfect entries and perfect setups. This is another pair. This is the Euro JPY daily chart. Okay? Here, this is a trade that I took, so I'm going to explain you why I drew this level right there. When I saw that the price was coming down here, this here didn't exist, okay? Price was coming down, but I saw that this level could have been one. So I drew my line right there. And then I went in the past to see if they would have touched that zone, which they did here. Touch, went up, and here once more, and here again. Okay, so I waited for the market to come to that level. They came from here all the way down. I waited for the market to come to that level and created a pattern, which they did. This one here, it's a pattern. They came down, creating this on the MACD, went up, further down, and here they're creating this on the MACD. Here it's going down like this, and this one is going up. This is another divergence. And from there, they went up, came back further down, lower than this one, but from here to here is going down, and this one is going up. This is the MACD for this one, and this one is going up. But the only thing is that there were no reversal candle. Okay, here, if I zoom in, you can see that this here, it's a it's not a reversal candle. This is a candle for a sell, and this is another reversal for a candle for a sell. So in this case, I would have not take the trade because I didn't see a reversal candle. So what happened is this: I was zoomed in to a lower time frame. When I saw that they were in this level, I zoomed in to a lower time frame, and I saw this right there. I saw that the price was coming down, creating this on the MACD, went up, further down, and creating this on the MACD. But price was going down like this, and on the MACD, it was going up. Another divergence. And this here, this is the same key level, and here was a reversal candle. And from there, they went up more than 200 pips, and the stochastic was under 20 on H1. And if I draw a line right there, right where my entry was, and I looked on H4, you can see that it's under 20 as well. Daily, right there under 20. And M15, same thing. M5, same thing. You get the point. Major key level met, reversal candle where a pattern occurred. Stochastic was under 20 on all the time frames that I told you, and then explosion. So what I did is simple. I identified a level that was obvious that the market was bouncing every time they came to the level. I map it out. I set up a notification system to get notified whenever they reach, and I wait for a pattern, and this happened. And then you wait for a reversal candle, which is exactly what we got right there. This is another hammer. Stochastic needs to be on their 20 on all the time frames, since this one is another H1 trade, daily, H4, H1, M30, M15, and M5, which is exactly what happened. And then you would have jump in the trade for an easy 50 pip. There you have it. 100 pips and more. Okay, you could have ordered this several times to take 500 pips, 800 pips in a single day, and you could have done this little exercise multiple times every single week. Here's another one. This is the EuroCAD daily chart. Okay, here you can see that I drew a major key level. Why? Because when I saw that the market was coming down, okay, I looked in the past to see if they would have touched that zone and reversed from there. Here we can see that they went here, came to my area, and then went up. Here it touched, bounced. Here again, they played there for a while. And here they touched it, went down. You get the idea already, okay? You start to understand exactly what I'm looking for. So here, that level, I waited for a pattern to occur, which they did. And the pattern was a divergence once again. Let me show you. Here, you can see that price went down, creating this on the MACD, went higher, went further down, creating this one on the MACD. MACD is going up like this. Price is going down, okay? Diverging. And if you take a good look, you can see a reversal candle on daily. 24 hours later, you could have jumped in the trade if the stochastic would have been under 20. And there you go, under 20 on daily. But since this one is on daily, the stochastic needs to be under 20 on monthly, weekly as well, and all the other time frames. Okay, so if I take a line and I draw it there, right where my reversal candle is, stochastic it's under 20. Let's look on the weekly if it's correlate. Under 20, monthly under 20. And if I look on the lower time frames, like H4, here under 20, H1, under 20, and the rest will be under 20 as well. I just don't want to do the exercise again and again and again because it's going to take longer for nothing. Okay, so but you get the idea, guys. Okay, this trade was on daily. They came to my area, they created this huge pattern, and they left a reversal candle, and the stochastic was under 20 on monthly, weekly, daily, H4, H1, M30, M15, and M5. And from there, they went up 400 pips. So if you're a swing trader, this is how you do it. Okay, you look on the higher time frame for major key levels, and the stochastic needs to be under 20 on all the time frames. And if we're looking for sales, we're looking for the stochastic to be above 80. And now we're going to look for sales. This is the GBP odd daily chart. Now we're looking for sales. Okay, I'm going to explain the same strategy, but for sales now. Now, here, the price, let's say the price is coming down here. It's coming down and then it's going up. Okay, you need to find your level. So let's say this doesn't exist. All of this doesn't exist. But here you can see that this could have been a level, and this one too. Why? Because obviously this is pretty obvious. When it came to here, they went down, further up, down, and then here they played in same area. So this is a obvious level, but to make sure, you need to go in the past to see if this level would have been a good one. And here we can see that here they play it, here they touch it, bounce, they came close, here again, and here. Okay, so here, this is definitely a level. So you mark a level on the daily chart, then you wait for the market to come up, which is exactly what happened. They came here. Remember, this didn't exist yet. So I was analyzing the market and I saw that this level could have been a good one. So you would have marked your level and wait for the market to come. So they came in that area. And what happened from there? You need to see if there's a pattern. Here, there's nothing for me, but obviously, maybe in the lower time frames. So what I do, I'm going to mark this here and we're going to find a level, the same level with a pattern that occurred that caused this drop. So I mark this level and now I'm going to zoom in the lower time frame on H4 and bam, this is my level. They create this huge pattern. What is it? From here to here, it goes upward, and on the MACD, it goes downward. This is another divergent. The price is diverging from the indicator. A reversal candle is there. You can see clearly. This is the reversal candle for a sell, right where my level is. Stochastic, it's above 80 on H. And let's look on same thing. Stochastic above 80. Let's look on H1. Same thing. And 30. Same thing. Okay, M15 will be the same, M5 will be the same. What just happened here? I mapped my level on daily when the market was coming up, and then I received a notification on my phone to tell me, hey, look at the market. Then I saw that there was no pattern on daily, so I looked in the lower time frames. And I saw this beautiful, huge pattern, a reversal candle, and the stochastic was above 80 on all time frames that I told you. Daily, H4, H1, M30, M15, and M5. Then I take a 50 pip right there. I hoarded this many times to take 500 pips, and off I go. Okay, you can go even further, but me, I like to take 50 pips. And I'll simply order several of them at the same time so I get 500, 600 pips for the same move instead of waiting. Here's another pair. This is the USD CAD daily chart. Okay, here, me, since I'm a pattern recognition expert, right here I can see a divergence right there. Okay, I can see that if I would have looked at this price action, the price would have went up, go down, creating this first on the MACD. Then I would have said, okay, let me see if I can find a level where they could potentially come and create a divergence. And I would have looked on the left side here, and I would have seen that level right there. Okay, I would have seen that level, so I could have placed this right there, and I would have looked in the past. And see this one here, another touch, an obvious touch here, and here and here. That's more than enough for me, okay? And then I would have wait for the market to come up to my level, which they did. They came up to the level, then they created this pattern here, which is a divergence once again. So I would have wait for the market to come here and create a pattern, but the stochastic would have need to be above 80 on daily, weekly, and monthly. But in this case, it wasn't above 80. So I would have only take this trade in the lower time frames, because if you look at H4, they came to the level. This is the same level. They create this huge pattern here, which is another divergence. Price action is going upward. MACD goes downward. They came to my level. They left a reversal candle. Stochastic is above 80. If I draw a line where my entry could have been, I look at daily, it's above 80. I look at H4, it's above 80. I look at H1, above 80. M30, above 80. M15, above 80. Okay?
Look, what I've just showed you here is some undeniable proofs that the major key levels are extremely important. And if you don't take advantage of them, you're missing out big time. When you combine this with everything that I showed you today, you simply put yourself in the shoes of the 3%ers who are winning the trading game. So for a quick recap, first you find the major key levels in the market, then you wait for a pattern to occur within the area of the major key level. A reversal candle must be planted on the exact time frame that you're about to take the trade, and the stochastic needs to be under 20 if it's a buy or above 80 if it's a sell on all time frames that